at what point do you think that we can stop saying that this company is early on in its profitability journey? I'm not trying to be mean or trying to call anybody out here, but we're 30 months in, right? This will be the 10th quarter of net income profitability, and we've been adding cash to the balance sheet based on the fact that we have positive ops cash for the last 48 months. So at what point which is 4 years, right? So at what point do you say, okay, it isn't necessarily a young growth company anymore? You need to start valuing it kind of like how you're evaluating Google and Amazon and things of the like, when valuations matter more so for those companies. Granted, yes, they're on a much slower year-over-year revenue growth. They're anywhere between 15 to 20%. Some of them are in between 10 to 15%. But at the same time, I don't think that you can just say that valuations don't matter in some sort of respect. I think we're getting to a place now where the grace period is kind of been given, and we're getting to a place where the company is kind of getting to a place where it's maturing. Net income is getting closer to the ops cash margin, etc. So things should start to align more so than diverge.
I never said that valuation doesn't matter. I said that I never look at pricing.
I'm not calling you out specifically, Amir. I'm just saying in general, for everybody.
So my approach to this is that we are currently 2023 $2.2 billion of revenue. This is for a business that has basically infinite TAM. I mean, I personally, by 2034, I have them doing closer to 40 billion from that 2.2 billion base from last year. So in that regard, you can't really say that this is a mature business. I mean, profitability wise, if we're looking at actual cash generation, I mean, they are very profitable and have been on a free cash flow basis, even to the firm, or if you do the traditional approach. I mean, we are around that 30% mark, so they are generating a lot of cash. But it's still like, what makes it mature or not is how much more scale there is to this business. And for Palantir, at currently 2 billion, they are just starting to scale up. Like we have 600 and some customers from a base that is basically worldwide, global, not counting.
Can we pull up that chart, Amir? Customer count. We could transition to that because that's a good conversation too.
Yeah, but also, sure. Touching on that, I mean, even if you do think you get to 40 billion and you get to a 35% net income margin, we're still at a price to earnings of 15x. Yeah, and that's all the way out, and when you get to a revenue of 40 billion.
That's like in 2033, right, or beyond that.
Here we go. This chart.
Yeah. Basically, Amir, your point is that we are so early in our customer count journey that you think that can grow. And to Palantir's credit, I mean, they've publicly said they barely have any customers at 600, and they believe they can have tens of thousands of customers one day. So your argument is the TAM plus the customer count growth makes it early right now.
No, what I'm saying is that a pricing approach doesn't really make sense at an early stage of a business to me. Well,
yeah, but
to me
Matt's,
personally, it never does.
But Matt's question is, why are we an early stage business? And my interpretation of your response is that because we barely have any customers. Is that correct?
No, because we are barely in the early innings of scaling up to what this business can be. I mean, when you're in the conversations of talking about a really mature business like Coca-Cola, I mean, okay, how much more bottles can they actually start to ship daily? I mean, there's a cap to that. I mean, that's a mature business. You won't expect a lot of growth. Sure, they will be profitable. They will reward shareholders. But there you can actually make a multiple approach where you start to look at, okay, what's the price to sales and PE that's worth? Because that business is not really like, as Aswat Damodran likes to say, he makes this argument with chapters of a book. I mean, it's at chapter 33 of 35 for Coca-Cola. Like, the story has already been told. They already use third-party bottlers to raise their profits, and they already scaled globally. They're available in every country. There's just not much more that Coca-Cola can do. For Palantir, we're like at chapter 5 of 35. I mean, this story can still go every which way. So in that sense, it's still a very young company. And even though we might have these expectations for the business, that's only a reflection of what we understand today. And as anyone can tell you about Palantir, Go back 2 years before AIP was around. The story that we could tell was completely different, and who knows what this looks like in 2 years. I mean, this is still very early in Palantir's story, so in that sense it's still a very young business, even though it's been around for 20 plus years, even though they've been publicly traded for since 2020, stuff like that. I mean, it doesn't mean that it's a mature business just based on how many years they've actually been operational, profitable or growing, because there's still so much untapped, is the argument I made.
Arnie, your thoughts?
Well, while the principal Matt is sharing that Palantir is maturing, and based on the maturity level, you try to have a different approach. I also disagree with that we are actually at a mature stage because, or even remotely close to the mature stage. Even the numbers are already very, very pretty for a simple reason. What's the connection with Coca-Cola? Coca-Cola almost saturated the entire market that it could potentially saturate, and getting that marginal customer becomes harder and harder. While with Palantir, it is actually the opposite. The marginal customer is easier to acquire, and the potential scale that it could eat is enormous compared with the cake that is currently eating. We are talking about how much? Probably like 1% of the entire market. Like we said, the TAM is expected to be like 1 trillion for the AI software market, and we are at a couple of $1 billion revenue. So that gives us a sense of how big the opportunity is. Now, obviously, it is impossible to capture the entire market, but it is possible, like Apple-wise, Tesla-wise, to capture the entire value, the entire profit of that market. And personally, I think we are such at a very early stage with that, and the number of customers just speaks for itself. Now, right now, I think Palantir has like a seed in almost all the industries, but we are talking about a couple of players for each industry compared with the total number of customers that could be achieved within those industries. And even with the leaders, even with these companies that we are talking, we are more familiar with, just something that keeps coming to my mind is the average revenue Palantir is getting from its customers is around 5 million. Correct me if I'm wrong. But there are customers that have been paying Palantir for like $10 million per year, which gives us a sense how much potentially these customers can keep improving, can keep expand. And the interesting thing is not that these very big, well, we know the top 3 are in the range of $100 million per year. The top 20 are more in the range of $50 million per year. They're not slowing down. Like, they keep spending more and more and more and more. That, to me, is an early sign of how early we are.
Mm-hmm. I know, Amir, you probably have some really good points, and I just want to say I agree with both of you immensely. Right, I am a Palantir bull. I believe that this will eventually be a $500 billion plus, if not $1 trillion company. But just taking a step back, Palantir is currently the 48th largest company on the S&P 500, and they're ranked amongst the folks of Pepsi, Disney, Caterpillar, Texas Instruments, BlackRock, Goldman Sachs, other very mature, not other very mature, but mature businesses, right? So at the point that I'm trying to make is we are currently being valued as a very mature business. And going back to Amir's point, at $40 billion, 35% in income, you're still at a 15 price to earnings multiple. Like that, that's a mature sort of valuation. Now, do I see us eventually getting to the 500 billion, top 20-ish sort of companies where you're starting to get to $500 billion plus? I do. But what I'm just saying is a lot of that value has been recognized, and it's going to take a long time to really get to a place where those valuations make sense. And yes, the net income margins might be better. The overall company and the need for it in terms of how its importance of American society might be there. But what I'm trying to say is easy money in this respect has been kind of made, and whether there's a pullback or not, I don't know. I can't predict anything. It's just my thoughts. But at the same time, I'm just trying to recognize where the companies that it's stacking up against within the S&P 500 are in terms of their maturity. And then you have this brand new company as you're. I'm not trying to be mean when I say this, but in terms of what you're saying, comparatively mature wise, a newer company like Palantir being ranked amongst these folks, it's kind of a sore thumb, right? And that's what I'm trying to point out, right?
I think it's the nuance of being a Palantir investor right now, because everything Amir and Arnie is saying is 1000% correct of how early we are in the journey. But everything Matt is saying is also correct of but we're valued like we're Disney or Pepsi. And it's very difficult to kind of resolve the fact that this is a $200 billion company that is just beginning, literally, they're in the infancy of their growth stage, but the market has already recognized so much of that value for whatever other qualitative reason, because it's not quantitative since the growth hasn't been there to justify $200 billion. And it's given us this valuation. So the question then becomes, can they have more growth to expand from 200 billion? Can they have enough growth to stay stable at 200 billion? Or do they not have the growth and we go back down substantially to then eventually get back to 200 billion? And I guess Monday's going to let us know how this plays out.
I think we are all aligned that Palantir is definitely overvalued and overpriced. No one is making that argument here, unless you are like some engagement farmer and post that it's going to 1000x from here.
1000x, Amir.
Yeah, there are some people saying 1000x, regardless of what is like. It could be a $5 trillion company. It's gonna 1000x from here, But no, I think we're all aligned with that. We all recognize that Palantir is definitely overvalued and very expensive. No one's arguing that, but I would argue the sense of maturity to the business. I still believe it's early. That doesn't mean that it should deserve any kind of multiple, any kind of valuation. Just to clear that up. And if we go back to earnings expectations, Arnie mentioned average revenue per customer. What I think is important when doing this is to exclude the top 20 customers, because they account for 46% of all the revenue. I mean, we have 630 customers. 20 of those make up almost half. So I like to look at this where we exclude the top 20. And we can see something interesting here. So ever since we could start to track this, it's just been going down, 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 down. However, the past 2 quarters, we actually have increases in the average revenue per customers, which is another example of AIP actually starting to add more value and actually starting to be a cost for current existing customers, which is like a scale lever, as we like to say. So going into next quarter, I would really like to see this continue. I would really like to see Q4 have also an increased acceleration. Now, this chart, it doesn't look like there's a lot of movement because the base in the beginning period here is so high. But if we can incrementally just keep increasing the average revenue per customer as we keep scaling customers, of course, that's going to be very attractive. And that's one of my expectations going into Q4. If we bring the talk back to Q4 earnings preview, I think that's something I'm really looking forward to see and hope for.
Mm-hmm. Personally, I don't agree with it is necessarily overvalued. We can say that the prices are high. I personally don't have enough brain to forecast the future, because the only way to really say that at this stage is literally having a Palantir degree accuracy into predicting the future. And my simple bottom line is, as long as the story keeps improving and that is reflected in the financial numbers, I believe the multiples will just go up or stay very high, because there's a narrative that supports the story. Now, since we are in the market where people are willing to spend a lot of money for valuations, but companies are also willing to spend a lot of money for the products, I think we'll see some interesting times ahead. And in terms of valuation, well, this 100x potential is becoming very famous, even a meme. But I would argue Palantir has a 1000x potential, not 100. The point is, what is having a potential? I have a potential of becoming 10 times richer than Warren Buffett. You can't disagree with this sentence. I have the potential, but that doesn't mean it is reasonable to think it will get there. And on top of that, it is not really to think as reasonable into getting there in a reasonable time future. So the 100x potential is one of those sentences that you can't disagree with totally from a rational standpoint, because it's one of those sentences that are almost every time true. Like Apple has another next potential from here, even if it is already 1 trillion or 2 trillions, whatever. The potential means there is a probability, at least 1%, a tiny probability that we could go there. That is potential. Now, as you start having like limits into those sentences, you realize how that converges into the almost impossible to happen, especially is if you have a time frame that is not 200 years from now, because we are talking about 17 trillions in the future, and it can absolutely get there if we think of Palantir becoming the operating system for the entire Western world. Now, that means that Palantir has the potential, but as investors, we really need to think in terms of, okay, what is the reasonable potential of Palantir achieving the good results in 5-10 years from now? And already trying to have an intuition, I'm not talking about precise numbers, an intuition into where we're going into that 5 years is already something that is very hard, but very valuable. While dropping 100x potential here and there is pure engagement farming. You can't disagree that we all have 1000x potential of becoming billionaires in 15 years from now. But you see, if you start saying in 10 years from now, the probabilities already change. In 5 years from now, there are possibilities. Maybe Amit goes all in into the right call options and goes straight into the billionaire stage. But you see, as you start adding limits to that sentence becomes closer to false. While if you don't say anything, you just drop potential, is one of those sentences that could be potentially almost always be true.
Let me just say that I would be willing to pay a high multiple for Amit's potential to become a billionaire.
I think Amit's got he's got the best chance out of all of us.
I think so. Yeah. So speaking of narratives, one narrative that Palantir was plagued with was very high SPC, and I think unfortunately, together with the SARS, it will bring that up, and people who just look at Palantir at a glance, which is majority, I would say, of people you run into on X, for example, other YouTubers, stuff like that, people that don't track Palantir as closely as we do, they will see something like this, and the SPC narrative might be back, because, as we know, we have a pretty expected high SPC expense that will come from SARS. So my initial forecast for the fourth quarter, not counting SARS, was going down to 19% SPC as a percentage of revenue, which is actually quite good. I think when I made the comparison between like 10, 15 peers, at least what Wall Street uses, like we're talking ServiceNow, Salesforce, Datadog, companies like this, the average SPC as a percent of revenue was actually 22.5. Snowflake, C3, stuff like that. So Palantir was up there, but still below like the average. And I had them going down, hopefully below 20 for the fourth quarter, something like 19%. However, we do have the SARS to expense, which will not look great, both on an annualized basis, but also on a quarterly basis. So don't be fooled when people talk about, they just have a high SPC, they have no cash. Because if we go and actually, one thing we didn't touch on yet, I mean, we don't have to spend time on it, but we've talked about it a lot. If we look at, first, operating margins, as we can see, ever since they had their first profitable quarter, even though it was due to a sale of a subsidiary in Japan, they weren't operationally profitable until Q1 of 2023. And then it's been scaling up, and this is what Arnie mentioned earlier, that no one expected how quickly they could turn this profitable. Like, I'm talking operations, because the net income, a lot of that is padded with interest income from the yield farming that they're doing with their cash. But if we look at operating margins, I have that continuing to actually go higher, up to 17% for the quarter, and over time, over the years, I have them at something like 40% in 10 years from now. So I expect that to continue to scale, but we have this huge drop in net income, which is if we actually add EPS. We do have some SARS expensing to do. My net income expectations are higher than Wall Street. That's why this 2 cents looks a lot better than Wall Street's post SARS of like 0.003. Like, that's why we might see that 90% miss if Wall Street is correct. But yeah, I have them at 2 cents. Wall Street, I think consensus came down actually. So Wall Street consensus for EPS was 5 cents the last time we spoke about it. It's actually down to 3 now, I believe. So there have been some adjustment. Raymond James came out, yeah, we have to lower it because of SARS. I haven't read every single report that's out there, but it's likely that people are lowering their estimates, which could be good for the stock price implications. Like, they won't have that massive miss. It will still be a miss, but not as bad as we initially thought. So just quick comments on the EPS miss, and if you guys think it will affect the stock price at all.
Personally, I was expecting more analysts to wake up to these SARS arguments. I personally expected, or even hoped, there was more than 2 people out of the more than 20, probably 25 analysts covering the stock that have seen or the analyst reports or Palantir Weekly or some of our comments, because we have been, I think, quite pushing to trying to make people explain why this could be a risk, but why also this could be more a headline risk more than an actual risk. Because even if we consider, okay, let's say almost $1 billion vanishes from the cash the company has, that has some effect in terms of future net earnings margin, because we get less revenue from an interest income. Okay, that's fair, but with these cases, we should not make the mistake most value investors are more prone to do, that is focusing too much in the numbers without focusing on the context. And what is the context is what really matters is the operating story to keep improving. And as long as that keeps improving, we could start not only think in terms of the price to be sustained, but having also a sense of how the operations can keep improving from here. Now, we mentioned there is a very big headline risk into these earnings, especially because we are not in the 60 something as a couple of weeks ago. And the higher the valuation before going into earnings, the more vulnerable you are from that perspective. And if you combine that with Palantir misses EPS because analysts didn't make a good job, that would be something that I would not complain with. It's just a risk that we need to be aware that could make the stock go down. Personally, I think for a short period of time. There was a comment from Brett on Twitter saying exactly that. Now, let me predict how earnings will go on Monday afternoon. 10K drops, banger. Okay, then people realize, oh, there are $120 million SARS expense that make the EPS drop. Boom. And then you have management actually explaining what was happening, and maybe people realize, okay, at the end of the day, that doesn't really care. What carries? When dividends. Not joking. But you see, at this moment in time, we're not in a bear market where people obsessively search for is a 16 times margin, while it was expected 17. We're now in the moment where the narrative is more important than the precise numbers. Now, all the algos are probably set to drop in case of a miss, but what really matters is how the management is able to convince the investors into this is not a story that is maturing, is a story that is keep improving and scaling. As long as they're able to share that, and I think with the latest interview, Carp made that very clear, we could be fine. And again, we are long-term investors. We could add, trim, or whatever, but if you are here, it's because we truly believe in the company and going forward for that future. And again, as long as there are improvements, very strong improvements in the story and in the underlying economics, that could be only a short-term risk, only if you're short-term.
Yeah, I agree wholly with what you said, Arnie. I think as long as management's able to navigate that, and I think it'll just be showing up more maybe as an annoyance rather than a big problem. Annoyance being, I think a lot of people thought, not that share-based compensation was behind us, but these big spikes and massive amounts of 40, 50% revenue sort of ratios where you have 50% of your revenue basically being diluted by the share-based compensation. I think the only time it'll actually show up in a very powerful negative way is if by chance we underestimated the SBC/SAR expense /PSRUs, whatever they're called, all these different items that we're kind of sitting here with a huge backlog of expense kind of hitting a wall at this point. And if the EPS shows up negative, I think that's going to be where a place where it's not going to show up favorably for management. It's not going to show up favorably, but I think we have sufficient ops margin, as Amir kind of showed on his graphic, that we should be able to eat it. But granted, it's one of those things where you really kind of have to shrug and put your arms in there and be like, I don't know what's going to show up. Is it going to be the 150 to 200 million that Amir is kind of having on his graphic, or is it going to be something that's diluted over the course of the next 2 to 3 years? I don't necessarily know how that's going to show up. And another piece, I think, though, is this will likely, like I stated, be an annoyance, not necessarily a thorn in anybody's side. But I think it's going to continue to be a topic of, what are we doing with this large cash balance of 4.8 billion, I anticipate by the end of this year. And, we've obviously stated that, okay, we're okay. We have $1 billion of potential buybacks that we can go and do, but we're only utilizing, I think it was like 5% of the ops cash that we actually get on a quarterly basis for the past 2 to 3 quarters to actually buy back any stock. What is the capital frame going forward, other than just continuing to stockpile cash? You're diluting shareholders. You have massive amounts of share-based compensation as part of your compensation package. I'm not saying that we need to fully offset that. Obviously, I think everyone's warranted to kind of get their share-based compensation. That's why we have some of the best engineers and other folks in the world that work for us, and that's why we're all invested in Palantir in general. But I think people are going to start to get, like I said, annoyed again that this is kind of a topic that's coming up, and we still have not really figured out an appropriate capital frame for the next decade. Meaning, how do we spend it, right? Capital expenditures, et cetera. We're going back and forth, and you have the Shield AI thing. Are we going back to what we did in 2021 with SPACs, which I actually was a fan of? Are you spending 10% there? Are you spending 10% on buybacks? What's the deal? Because this consistent contribution of cash to the balance sheet isn't necessarily the answer.
I mean, I think you're right. That's a huge question on a lot of people's mind. And I think even the interview on CNBC yesterday, I just caught it like quickly. I don't know the full context. Amit covered it, so maybe you can add it. But I recall he said we basically have infinite cash. Did he also comment in what context? Like what is he expected to spend that cash on? Did he mention that? I don't remember from the short part I heard.
It was kind of a comment in the context of growth. So he was like, we're only limited by America's capacity to adopt this type of innovative technologies in regards to AI. And then we're only limited based on the number of people that we have that would be willing to fulfill the demand coming from the US commercial business. And that's where he said we kind of had this unlimited money, because basically he was trying to say it's not about the money. It's just about the ability to execute on the demand itself.
Yeah, so that's in line with what he has been saying, like historically, like we are not cash constrained. That's something he's been saying for 2 years now.
Yeah.
Arnie, did you want to say something? Sorry.
No, I just see Carp more focused into making the right choices that could affect the company for a very long period of time, rather than trying to squeeze the most he can from the short-term opportunities that he could have. Like the short way would be, okay, let's spend all this money into marketing so that we can sustain the growth. But Carp seems to playing a different game. What kind of game Carp and the management are trying to play? Because that's what could give us a sense of are we making the right decisions into making this cash pile keep compounding or not. Personally, I believe they were playing the game of let's signal that we are a very serious company, that interest rates are high, so we know that is a tough environment, and we can just show that we keep accelerate while also expanding the margins, while also having a very strong cash pile. Essentially, we are a company that from an operating risk profile, we have almost no risk, and you are encouraged to become a partner of us, while alternatives are maybe weaker. They are not profitable. They are not able to find the right go-to-market, and that increases their reputation immensely, because right now Palantir can show by using our tools internally, and they have been quite open to share that they deploy Palantir internally very heavily, we are able to achieve these results. These are the results that you also want: accelerated growth, expanding your margins while printing a lot of cash, and which means having a ton of optionality if you want to go into one direction or the other. We need to think of cash as the optionality that we could have. Is like being an investor. The more cash you have, the more optionality you have to manage downturns. You don't have too much pressure into making short-term trades that give you $50. You're more, okay, let's make one step back. I don't need to rush into making a decision, but I need to be fresh into being able to spot where the market is really going. And meanwhile, I keep increasing my optionality, because there will be a day where this cash could be really useful, maybe to make an acquisition. Maybe it makes sense now, in this moment that we have the validation that the Palantir thesis is working, it makes sense to make investments in the sort of what I would have hoped Palantir would have done with Unreal. But there are some talks now that Palantir could be invested in partners like Shield AI, which is a defense company operating in, is a defense tech company for which Palantir seems to be in talk to invest in the capital. So this is something that when you have excess cash to grow while not sacrificing your growth, your expansion, could be very strategical, because it's not only a cash deployment, it's also a proof that your solutions work. And personally, since these SaaS can have a direct impact on the cash, because we're talking about a cash expense here, the management per se didn't really expect the stock price to hit this hard by, like, the SaaS were designed to be effective up to 2029, and we arrived there essentially 4 or 5 years before that. So that caught by the management by surprise. And as Emir noticed, okay, the newest SaaS are not based with the same limits. They are actually SaaS that require more vesting. So probably the management acknowledged that that would have been a better way to deploy the optionality of giving optionality to employees.
And before we move on to TCV, I agree with a lot of what you said, Arnie, and I 100% agree with you. I'm okay to be coached, right? These guys know way more about the business than I do. I'm just a bystander, but as all of us as investors, if you were to tell me we were only investing back into our business or buying or investing 5% of our cash that we get on an annual basis, I'd be pretty upset with you, right? So we're going to make about $1 billion in ops cash to the balance sheet in fiscal year 2024, of which we've only spent 40 some million dollars in buybacks, right? So I'm not saying, when I talk about an annoyance, I'm not talking about let's just go drop $1 billion here, $1 billion there, and I don't think you're perceiving it that way either. But my thought process is I would like to hear some capital frame metrics that they're looking for. Are they going to set aside 20 to 25% for investments like they are for Shield AI? And it might not necessarily be on a quarterly basis, but it might be on a rolling 12-month basis or maybe rolling 24-month basis that they're putting aside, however many billions of dollars in case of 24%, 25%, let's say. That would be close to $500 million every 2 years at the current run rate to be able to invest in something like that. And I think that's reasonable. And then same thing with buybacks in the future. We're a growing company that's very low capital expenditure. And so, like you stated, I'm not expecting them to just drop 2 billion, 3 billion out of that 5 billion or anything like that. But at the current run rate, at this time next year, we'll be at over $6 billion in terms of cash on hand without any sort of intervention. At what point, like you stated, I'm willing to be coached. I'm willing to understand where management's head is at. But, without that guidance, it's always going to be a question that people ask and bring up, especially myself on a quarterly basis.
Sorry, Matt. Why do you think Apple got that insane cash pile before it started doing buybacks? I think you know that at a certain point, Carl Icahn, the activist, went in the board of Apple and started pushing, okay, you need to deploy this cash for buybacks because it makes no sense you're keep piling it. I think they reached something obscene like
I think Palantir is even in a more exacerbated situation, because if you were to say how much was Apple investing in terms of CapEx, I don't know the answer, but I'm just going to say it was probably roughly 20 to 30% of whatever they were making in the early days. Now it's probably less than that, 10, 15, maybe 20%. But I don't even think Palantir spends 5 to 10% in capital expenditures. So you literally now have 90 to 95% of all your capital that you're getting from an ops cash perspective going directly to the balance sheet. Mm-hmm. And I don't have that answer. I'll actually look at it. I'm kind of curious now that you're sort of mentioning it. But you talk about other companies like oil companies, et cetera, much more capital intensive. They have to have a much more stringent capital frame. But Palantir, because they have so little capital expenditure, they're such a huge gross margin business, they can literally not really have to worry about it at all. And I don't think people really blink an eye. But once you start to get to the point where you have literally more cash on we're basically getting to a point where we have 2 years worth of revenue in terms of a cash pile. That's pretty significant.